We're going to take it slow and steady, keep it nice and even today in our video. We're going to be talking about straight line depreciation. Welcome to Accounting How To. I'm your host, Carolyn Grimm. That's my sidekick, Terrence. In today's video, we're going to be exploring how to figure straight line depreciation. Now, if you need an overview of depreciation, I will link my Depreciation Explained video up in the corner and put it in the description as well. So straight line depreciation is one of the methods that we can use on our accounting book in order to track the decrease in value, the expense involved in an asset that we're using in order to make revenue. So let's jump into our spreadsheet. We'll look at some examples of assets and how to depreciate those using straight line depreciation. We'll use the same assets for our other depreciation methods so that you can compare and contrast and see how that changes the picture for our income statement and our balance sheet. So let's jump in. So we're going to be looking at 3 different assets, and we're going to use those sample assets to work through a straight line depreciation example. So we have asset number 1 is a 2015 Ford F350. We have a Hobart mixer for asset number 2, and we've got a forklift for asset number 3. So here's what we know about asset number 1, our 2015 Ford F350. We have given it an asset name in our fixed assets of Ford F350. Now, we could have put it into a group asset called vehicles, but in this case, we're going to keep it simple. We're going to have it in its own asset account. The cost that we paid for this is $24,000. So this is going to be our depreciation basis, $24,000. We are estimating that this is going to have a 7-year useful life. And we think that in 7 years, that salvage value, the residual value, is going to be $2,000. So this is our estimate. And we think that we're going to get 100,000 miles out of this asset. In asset number 2, our Hobart mixer, the cost was $5,000. We think it has a useful life of 5 years. And when it is 5 years old, we are estimating that its salvage value will be 0. We're going to beat this thing up. That's what we're saying. And we think that it has about 20,000 hours of running time. Our third asset is a forklift. We paid $8,000 for it. Our useful life, we think, is 5 years. We think it's going to have a salvage value of $500, and we think we're going to be able to run it about 3,000 hours. So we're going to take that information and we're going to jump over into our straight line depreciation spreadsheet. So the first thing that we need to know is, how do you figure straight line depreciation? What we're going to do is we're going to take our cost minus our salvage value, and then we're going to divide that by the number of years in our useful life. So with asset number 1, our cost was $24,000, our salvage value is $2,000, and our useful life is 7 years. So we're going to take $24,000 minus $2,000 and divide that by 7. And what that gives us for a year's depreciation is $3,143, and I've rounded all of these numbers just to keep it simple. But in keeping with the matching principle, because we want to be GAAP compliant, generally accepted accounting principles, we would be doing a monthly adjusting entry for our depreciation of $262. So every month we're going to do a journal entry, an adjusting journal entry for $262, and we're going to do this every month for 7 years. So our journal entry, our adjusting journal entry, is going to be a debit to depreciation expense of $262 and a credit to accumulated depreciation for $262. Now, time is going to go by, and we're going to do this entry over and over and over again. If you're using accounting software, the great news is that you can set it up to automatically do this for you. You don't have to remember it every month. So when we get to the very last month of the last year that we have been using this asset, here's what our balance sheet snippet would look like. Here's our cost, our Ford F350 for $24,000, accumulated depreciation that we have booked totaling $22,000, And our net book value is $2,000, which is our salvage value. So what we did was we depreciated everything but the salvage value. So when we're all said and done, we want to have our salvage value showing up here on our balance sheet. That means we've done everything the way that we should. Let's look at our Hobart mixer. Our Hobart mixer had a cost of $5,000, salvage value of 0, and a useful life of 5 years. So when we take our $5,000 cost minus our 0 salvage value and divide that by our 5 years useful life, it means that every year we're going to be taking a total of $1,000 in depreciation expense. But to keep with the matching principle, we want to do an adjusting journal entry every month for 5 years of $83 a month. So depreciation expense, debit of $83, accumulated depreciation, a credit of $83. Time will go by, we'll keep doing our journal entries, and then on the final day of the final year of this asset's life, this is what our balance sheet should look like. We should have our Hobart mixer at $5,000 in cost, and our accumulated depreciation is $5,000, leaving us a net book value, which is our residual value, our salvage value of 0. So as far as our balance sheet goes, this asset has no value. Now we could still go out and sell it, get money for it, but as far as the accounting depreciation, we have recovered all of our cost and we have expensed all of that cost of that asset. Now let's take a look at our forklift. Our forklift was $8,000 cost, has a salvage value of $500 and a useful life of 5 years. So $8,000 cost minus $500 salvage value. Our depreciation basis is $7,500. We're going to divide that by 5 years. So each year we're looking at a depreciation deduction of $1,500. To keep with the matching principle, we're going to now do 12 journal entries every year for 5 years at $125 depreciation expense debit and $125 accumulated depreciation credit. So when we're all done with our depreciation entries for that asset, our final balance sheet is going to say our forklift cost of $8,000, accumulated depreciation $7,500, and our net book value is $500. Now the benefit of doing straight line depreciation, of course, first of all, it's easy to do, right? You're going to take your cost minus your salvage value and divide that by your number of years. So it makes it very simple to figure depreciation. The other part of that is that it gives you a nice steady expense that you can count on. You know ahead of time what it's going to be, and it helps with planning, it helps with budgeting, and it keeps things very stable. You'll see with our other depreciation methods that some of them start out much higher and drop low, and some of them are variable depending on the use that we use that asset for. So that's it for straight line depreciation. We have other videos available in this playlist series for sum of the year's digits, for declining balance, and for units of production or units of activity. So join me as you need to for those other videos. Until next time, stay balanced, my friends.